Corporate finance practice problem using OneNote. Convertible bond, pure bond value impact versus conversion value impact on price. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 1931 Convertible Bonds, Pure Bond Value Impact versus Conversion Value Impact on Price tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations then on down below and to the side. We're looking at our convertible bonds, those being the bonds that have the option but not obligation to convert into some number of shares, and we're thinking about the impact or the play between the bond price and the pure bond value, which would be the comparable value to comparable bonds, which does not have the conversion feature option for it. So our information, we have the convertible bonds outstanding, the rate at the 12%, the par value at the 1,000, the conversion ratio, meaning the bonds can be converted into 45 shares of stock if so chosen. They mature in 15 years. The conversion premium is going to be $98. That's the amount over and above the conversion value that the bonds are currently selling for. And then we have the semi-annual, meaning they're going to be semi-annual interest bonds. Interest paid semi-annual as opposed to annual. Stock price is $35. 1 year later, we're going to assume the stock price is then $42. Therefore, stock price goes up 1 year later. Conversion premium then at the $35 as opposed to the $98, which typically often the case, the conversion premium possibly going down as time passes. Yield similar bonds is the 9%, meaning similar bonds are yielding the 9%. So let's start off with the bond price. We're going to consider the starting bond price, which is going to be then the conversion value. So we'll have to do a little bit of a calculation for the conversion value here. So the conversion value is going to be the number of shares we can convert to, which is going to be 45 times the stock price, which is 35. So in other words, if we were to convert the bonds at the starting point, we would have the conversion ratio 45 shares times the stock price of the 35 to give us the conversion value of the 1,575. We have the conversion premium of the 98. By definition, the conversion premium is the amount over and above the conversion value to get to the bond price. You might then memorize kind of the calculation for the conversion premium and then kind of back into if you were solving, say, for the bond price as we are here using your algebra. And if we add those up, that's going to give us the bond price of the 1,673. Let's do the same thing for the ending bond conversion value. This time we'll look at the conversion value first. Ending bond conversion value, we have that same 45 on the conversion ratio, but now we're saying the stock price has gone up from the 35 to 42. So 45 times 42 is going to give us then the conversion value this time of the 1,890 as opposed to the 1,575 due to the stock price increasing. The ending bond price then is going to be that conversion value, the 1,890. We're going to be adding to it the conversion premium given 35. That by definition is the amount over and above the conversion value that the current stock bond price, convertible bond price, is at. Therefore, the convertible bond price, the 1,890 plus the 35 is the 1,925. Let's calculate the interest earned. So if we're thinking about what's going to happen a year later, we need to consider the interest that has been earned during that time period. We have the $1,000 par value bond. Interest rate is going to be the 12%. We're going to say interest is earned then at the 120. The rate of return calculation can be calculated as the ending bond value. We're valuing the bond at that 1,925 at the end. We then have the starting bond value at the 1,673 we calculated. That means the bond has increased in value. We're going to call it a gain of the 952. The interest earned, we also have interest earned here that we calculated up top at the 120. Now notice that when we calculate this, there might be differences in the type of income that we have for tax purposes. Is it taxable? Is it interest? Is it taxable ordinary income rates and whatnot? We're just calculating the return here, though, in this case. So we had an increase in the value of the bond, 252. We got the 120 interest earned. That gives us the total increase of the 375. Comparing that to the starting bond price, where we started out, that's going to be the 1,673. That then is going to give us a percent return of 22.24, otherwise calculated as the 372 divided by the 1673. Moving the decimal 2 places over, we're about at the 22.24% about. Now let's think about the pure bond value, meaning the value of the bond if there was no conversion, looking at related bonds that don't have that conversion value. So the calculation for that would typically be the present value of the interest payments, that would be, and then the present value of the face amount, par value at maturity. That would give us the bond value. We won't go through the calculations in depth themselves. We do them in Excel if you want to look at that with the Excel format. Note that we do have prior presentations where we focus on this type of calculation a lot. So you can do a whole section on that. We also look at a present value calculation section. And note that you can do these present value calculations with tables, with formulas, or with Excel. We focus on those in prior presentations. We won't put a lot of detail on that here. So the present value of the interest payments, in other words, we're going to have interest payments of $1,000 times the 12% divided by 2 because they're semi-annual, and those will be happening for the 15 years minus the 1 year that has occurred here. And the number of periods then would be the 15 minus 1 of the 14 would be years times 2 would be the 20 or the 28 periods that we would have then. So if we present valued those using the 9% down here, we then are going to be getting the 944.57. Then we have the $1,000 that would be gotten at the end of the maturity time period. Once again, present valuing it at the 9%, giving us the 291.57. If we add those together, we're going to get the bond value of the 1236.14. And what am I doing here? Hold on a sec. The 944.57 plus the 291.57 gives us, one more time, something happened. The 944.57 plus the 291.57 gives us the 1236.14. So note that because the pure bond price is less than the conversion value, the pure bond price at this time has no significant impact on the actual bond price. So in other words, when we look at this pure bond price and we try to think about, okay, what's the value of this security, it's going to have less impact because that pure bond price is less than, if we go back up top, the conversion value. The conversion value meaning if we were to convert this bonds to stocks is at the 1,890, whereas if we look at the bond price, then we have the 1,236. So when we're considering the value of the stock, of the bond itself that has that conversion option, we would consider or assume that the larger amount, the 1,890, would be a more significant impact on the price of the bond. Even though you have that kind of hedge against something happening, it going down, you still have the bond in place. So you would think then the conversion value would be kind of like the driving factor for the valuation, the price, what the market would be determining the price to be of the bond. So once again, because the pure bond price is less than the conversion value, the pure bond price at this time has no significant impact on the actual bond price. The primary factor at this time that impacts the bond's price is the stock price. The stock price, which would then be calculated into the conversion value and be calculating this 1,890 conversion value.